So welcome back guys. Today we are going to start with a new chapter which is depreciation and amortization. So you would have heard the term depreciation in each and every chapter, but now we'll understand what is the exact meaning of depreciation, what are the types of depreciation, why do we actually depreciate the asset, why do we actually reduce the value of the asset. Okay, so the meaning and nature of depreciation. So what are our learning outcomes of this particular chapter? It is the meaning and nature of depreciation. What is the meaning and what is the nature, and how do we determine the amount of depreciation? So we know that depreciation is nothing but writing down the value of the asset, but why do we do that and what are the methods we follow, and understand the various methods of depreciation and disadvantages of it, and how to calculate the amount of profit and loss resulting on sale or disposal. So now you purchased a car, you used it for 3 to 4 years, then you sold it, but you can't take the selling price minus cost price because there is another factor known as depreciation which comes into picture. So when you purchase the asset, it will be 10 lakh, but when you sell it, it will not be 10 lakh, maybe 5 lakh, 6 lakh, depending on the nature of asset. But the 10 lakh, you cannot separate directly 10 lakh from the sales value because the amount of depreciation we have to calculate, because there will be normal wear and tear, there will be obsolescence, everything will be there. So familiarize the accounting treatment for change in the method of depreciation from straight line method to reducing balance method. So if you are changing from one method to another method, then also we need to see the accounting treatment. Okay, then familiarizing the accounting treatment for change in estimated useful life. So what is useful life now? If you take the estimated useful life of a car, now in India, car normally we use it for 15 years, then normally government tells you to scrap it because now they have new rules telling that you cannot use more than 15 years of any car or motor vehicle, so you have to scrap it. So that, what is the useful life here? 15 years. So then the residual value is nothing but after 15 years, if you sell the car, what is the amount you get? That is known as residual value. Obviously you will be getting a minimal amount, true? So that is known as residual value, and we will see the accounting treatment for that and understand the meaning and nature of intangible assets. So what are these intangible assets? The assets which cannot be seen in our naked eyes, which means I can't see it directly, but it has value. Example, trademark, patent. See, the name Tata, the name Reliance has a brand value, so that cannot be seen, but it has some value. If you want to take the brand Reliance in your name, now you are a ABC company and you want the brand name Reliance, think how much amount you have to pay, because what is the market cap they have captured. So that is what intangible asset means, and it's amortization is nothing but depreciation only. So when you reduce the value of asset, which is tangible asset, which can be seen, maybe plant and machinery, furniture and fixtures, building, it can be anything, that is known as depreciation. And when you amortize, which means when you reduce the balance of an intangible asset, that is known as amortization. Okay, reducing the value of intangible asset. So now the overview of chapter. So what is the objective of providing depreciation? To ascertain the result of operation, which means, see, now a fixed asset will cost you huge, maybe 1 crore, 2 crore, but you cannot immediately debit it to P&L account because it is not for 1 year. The benefit which you are getting from the fixed asset is not for 1 year. It will be more than 1 year normally. Normally it's useful life. So if the useful life is 10 years, fixed asset will be there in the business for 10 years. So what we will do, we will divide the cost for equal number of years, which is the useful life. So we will be depreciating for all the number of years. Okay. So this helps us to present the true result of the operation. Normally what is depreciation? We are allocating the cost of the asset to its useful life, that's all. So if my useful life is 10 years, see, this is the useful life. I am taking 0, 1, 2, 3, 4, 5 years. So it basically 5 years. So what I will do, if my cost is 100 rupees, I will put this 100 in all these years. The cost I will be distributing in all these years. Now we will see the method of depreciation, if it is equal, reducing balance, that and all we will see further. But allocating the cost throughout the useful life is known as depreciation or amortization in case of an intangible asset. To present true and fair view of the financial position. Obviously, what is financial position? Balance sheet. So in balance sheet we get the asset. It may be tangible asset, it may be intangible asset. So we'll get the true picture, which is after depreciation, which means the market value normally. So when you purchase a car for 10 lakh, it will not be 10 lakh for throughout the life of the asset. Correct? No? Obviously value will come down. So that return down value is known as depreciation. To accumulate funds for the replacement of assets. So what do? We accumulate funds from, which means we take out the profit. We take out the part of a profit and keep it in a reserve to purchase a new asset for replacing the existing asset, to ascertain the cost of production, true cost of production. So what are the factors affecting the depreciation? Mainly cost of asset, because that only we use it for depreciation. Useful life and utility, which means how much time we will be using the asset, and the residual, the estimated residual value, which means at the day one only we will estimate that residual value may be this much. It can change. It is not 100% true that it will be the same. It can change, but we will be estimating it. See, it is telling estimated residual value. Okay. Now, concept of depreciation. Tangible assets are assets that have physical substance, which means can be seen and touched, as they have told, held for use in production or supply of goods or services. So why do we use assets? We use it for production or supply of goods and services. So we will be using these factors. So if you want to produce this pen, we need machinery. So we will be having some robotics which will be performing the operations of creating this mold. So that is what we are using in production. And if we have vehicles, so we will be using it for supply. We will be giving it to the wholesalers, retailers, customers, depending on the supply chain, for rentals to others, and for admin purpose. So we will be using computers, laptops for accounting purpose, billing purpose. So all this will be known as the tangible assets, or which can be seen and touched or felt. Okay. Useful life of tangible asset is based on the expected usage. I told you, car 15 years, then laptop 5 years, something like that. It will be given in the question. Property, plant and equipment are tangible items, which means it can be seen, touch, okay, that are held for use in the production or supply of goods or services, held for rental. So I own a building, I rent it out. So because of that building I am getting rent, so it is also an asset. And for admin purpose, laptop or computers are expected to be used during more than a period of 12 months. I told you it should be for more than 12 months. Otherwise, we will be sending it to the P&L account. Obviously, no, because the benefit will exist within 1 year. So, if the benefit will exist within 1 year, we give it to the profit and loss account. And if it is more than 1 year, we have to check. It will be a part will come to the profit and loss account and not the whole amount. Okay. These are also called fixed assets. So, normally what do we call these assets? As fixed asset in common parlance. So when a fixed asset is purchased, it is recorded in the books as at its original or acquisition or purchase cost. So in chapter number 1 we saw what is original cost, the amount which we paid at the beginning or at the purchase of the asset. However, fixed assets are used to earn revenue or save cost for several accounting periods, which means more than 1 year. Several accounting period means more than 1 year in future with the same acquisition cost until the concerned fixed cost is sold and discarded. For example, acquisition of a machinery expected to be used for 10 years in production of finished goods will earn revenue for next 10 years. I told you, if you are having machinery for which is having a useful life of 10 years, so it will help you to earn revenue for the next 10 years. Similarly, an ATM machine installed by bank will result in cost savings over the expected life of such ATM machine for the banks in terms of not requiring to employ personnel to dispense cash. So, what is the purpose of visiting the ATM? To draw cash. So, if you put an ATM, so the person will not come to bank for withdrawing the cash. So, you saved a salary of a person who will be dispensing cash. There will be a cashier in the bank, his salary is saved. Obviously, if you put an ATM. That's what they are telling us. Since the life of such asset exceeds 1 year, it is necessary that a part of the acquisition cost, I don't know, since it is more than 1 year, a part of such cost is treated or allocated as an expense in each accounting period. I don't know, in this, if we put it as equal amount, so it will be 20 each. 20 into 5. So not this 100 will come to P&L, only this 20 will come to P&L. That's what they're telling. A part of the acquisition cost will come to the profit and loss account in which the asset is utilized. The amount of the value of fixed assets allocated in such a manner to respective accounting period is known as depreciation. I told no, the allocation of cost over the accounting period or over the useful life is known as depreciation. Value of such assets decreases with passage of time, mainly due to following reasons. Next, wear and tear due to its use in business. So why do we depreciate a following asset? So first one is normal wear and tear. So you drive the car, obviously. So after some period, the value will obviously come down, no, because it is a second-hand vehicle. Then a flux of time, which means the period of time which you have used. Obsolescence due to technology or other changes. Now every car has inbuilt technology, maybe Bluetooth, something like that, maybe touch screen, all those features. If you are not having that, or if you are having the old feature, it is outdated. Decrease in the market value because a next model has come in with new add-on features. Correct, no? Depletion mainly in case of mines. So mines means, so when you take out the gold, obviously it will deplete because you will not get again and again, like the air and water, how water and air is refueled in nature. The same way the minerals are not refueled. Once you take it out, it is done. It will deplete, and other natural resources. So it is important to account for the value of proportion of property, plant and equipment. So this is major change. Okay, earlier we used to tell it as fixed assets. Once 2013 Companies Act came into force, we used the term property, plant and equipment. Now don't use fixed assets. Fixed assets is outdated now. Now please use property, plant and equipment. Okay, utilized for generating revenue during the accounting year to ascertain true income. In other words, against the income or cost savings generated during a year, it is essential to book the portion of cost. I don't know, as per matching concept. So for that revenue, you have to match this cost. So how much asset you used, or maybe number of hours, it can be anything. We'll see the type of depreciation. That much amount of cost should be allocated to that particular period. Now, if suppose I have used 100 hours and the total capacity is 1000 hours. So that 100 hours cost should be debited or should be proportionately booked as expense for that particular period, utilized in generating such income or cost savings. This portion of cost of property, plant and equipment allocated to an accounting year is known as depreciation. So same thing that they have told again, allocation of cost. Next, as per schedule 3, as per schedule 2. So in schedule 2, we see that depreciation, how do we calculate depreciation and method. In schedule 3, we see the format of balance sheet, profit and loss account, cash flow statement, etc. Under the Companies Act, depreciation is a systematic allocation of depreciable amount of asset. So what is the depreciable amount? The cost which should be depreciable. Normally residual value, it is not a depreciable amount. So how do we calculate depreciable amount? So if you want, you can write this one. Simple. So total cost or acquisition cost, whatever you tell, minus the residual value. That's it. Because this residual value is the amount which you get. So on that you cannot claim depreciation. So this is the depreciable amount. Okay. Over its useful life. The depreciable amount of an asset is the cost of an asset or other amount substituted for it. That is, in case of revaluation, such revalued amount less its residual value. I don't know, cost minus residual value, but that cost can be increased also when there is a revaluation. So when is the case of revaluation? Example, in case of a land. So land value today if you take, and after 10 years if you take, totally different. The value will be totally different. So at that stage, what we have to do? You have to increase the asset. If the law permits, okay, if the law should permit for revaluation, otherwise you cannot do it. So in India, normally law will permit for revaluation, but in other countries, in US and all, it is not allowed. Revaluation is not allowed. So the useful life of an asset is the period over which the asset is expected to be available for use. I told no. Example, car in India, 15 years. By an entity, or the number of production or similar units expected to be obtained from the asset of an by an entity. So there are three factors which is affecting the depreciation. What is that? Useful life, cost and residual value, which we saw in the beginning. Next, depreciation of an asset begins when it is available for use. So now I have constructed an asset but it is not ready for use. Can you charge depreciation? No. When it is available for use, which means using that I can produce goods or generate revenue, at that stage depreciation will start. Okay, that is when it is in the location and condition necessary for it to be capable of operating in a manner intended by the management. So management tells that, oh okay, this machine is ready for use. At this stage depreciation should start, not before that. Thus it is not necessary that an asset must be purchased to be depreciated. There is a decrease in the value of asset due to normal wear and tear and obsolescence even when these are not physically used. Accordingly, value of such wear and tear should be estimated and accounted for. Depreciation is allocated so as to charge a fair proportion of the depreciable amount. So you know what is depreciable amount? What is that? Cost minus residual value. So that fair portion, which means it can be equal proportions of the useful life, maybe some value, it can be based on anything, that should be allocated to the particular financial year or accounting period. During the expected useful life of an asset, depreciation for a period helps to charge that proportion of the cost of the asset against the revenues earned, which is expired for that period and hence follows matching principle. I told now for that particular revenue, this is the particular cost which is for the period, accounting period. In other words, total cost of the asset is reflected in the form of expired cost, which is depreciation, and unexpired cost, which shall be returned on value of the asset. So whatever amount which is shown as depreciation for a particular period, that is known as expired cost, which means it is already expired, and what is the balance amount, that is the returned on value or the unexpired cost. Also, charging depreciation every year reduces the distributable profit, which means if you claim the expense of depreciation, obviously profit will come down, obviously, no, thereby ensuring the availability of funds whenever the replacement is required. This depreciation is a type of loss in the value of assets employed for carrying on the business. Obviously, because it is debited to P&L account, it is a type of loss. To make a provision and therefore arrive at the amount of profit or loss made by the business. Basically, the cost of an asset used for the purpose of business has to be written off over its economic or useful life, which must be estimated. So I told now depreciation is mandatory. You have to, if you are having an asset and if it is a depreciable asset, you have to 100% claim the depreciation. The point to remember is that usually at the end of the economic life, asset has some value as scrap. I don't know, scrap is nothing but the value which you get at the end of the asset when you sell it. The amount to be written off in each year should be such which will reduce the book value of the asset, which means the value of the asset should come down at the end of its economic life to its estimated scrap value. So you have to reduce such amount of depreciation until it reaches the estimated scrap value. Okay. Depreciation on components of the assets. Now we will see the depreciation on components of assets. It may be noted that the accounting standards as well as the Companies Act 2013 requires depreciation to be charged on component basis. Each part of an item of PPE, which means the other name for fixed assets, with a cost that is significant in relation to the total cost of the item, should be depreciated separately, which means if the component of a particular asset is having a significant value when considered to the main asset, we have to keep it separate. That's what they are telling here, and it should be depreciated separately also. An enterprise should allocate the amount initially recognized in respect of an item of PPE to its significant parts and components, and should depreciate each such part separately based on the useful life and residual value of a particular component. For example, aircraft is the classic example. So they are telling aircraft is the classical example. Why? See, the airframe, the body of the aircraft, the engines, the interiors have different individual useful life. Obviously, if the life of the airframe being the longest of the individual lives of the three major type of the components is taken as the life of the aircraft, it is important that two other major components, which is the engine or the interiors, are depreciated over the respective useful life and not over the life of airframe, because these three are having different useful life and these three have a significant value. That's why other components, usually small and low value, which will require replacement very frequently, may be depreciated over the useful life of the airframe, and their frequent replacement may be charged to an expense as and when it is occurred, because it is normal wear and tear. So if you see the seat covers, they have to change it very frequently. It cannot be booked as a fixed asset. Okay. Here it is important to note that a part of PPE is to be identified as separate component should have both. What is that? It should have significant cost when compared to the overall cost of item of PPE. So which means it should have a major cost when compared to the actual asset, and the estimated useful life should be different. Estimated useful life or depreciation method different from the rest of the parts. So two conditions is to be satisfied for separate depreciation for component. One is that it should have a significant cost, and second is that it should have a different useful life. If it is having same useful life, and what is the use of differentiating it? It can be anything, it can be same, that's why. Next, a significant part of an item of PPE may be used, may have a useful life and a depreciation method that are same as useful life and the depreciation method of another significant part of the same item. Such parts may be grouped in determining the depreciation charge. Okay. Next, we'll go to the objective of providing depreciation. So what is the objective? So we saw one liner at the beginning. Now we will discuss in detail. The first one is correct income measurement. So there will be a correct income measurement. Income is nothing but net profit after depreciation. So normally we find out net profit, but we have to take it after depreciation. So depreciation should be charged for proper estimation of periodic loss or profit. In case of a depreciation, in case of an enterprise does not account for depreciation on PPE, it will not be considering loss in the value of PP. So if you are not considering depreciation, which means you are not recognizing the cost of the asset for that particular period due to their use in production or operations of an enterprise, and will not result in true profit, because we are not allocating the cost of the asset. That's why. So next, true position statement. So value of the property, plant and equipment should be adjusted for depreciation charged in order to depict the actual financial position. So true financial position is nothing but, what is financial position? It is the balance sheet. So financial position is nothing but what is the total of asset and what is the total of liabilities. Okay. Now because of depreciation, we will be calculating the true position, which means whatever asset we have to bring it to market value. Normally market value, how do? We reduce the value of the asset, but the name which we give is as depreciation. Okay. In case depreciation is not accounted for appropriately, the property, plant and equipment would be disclosed in financial statements at a value higher than its true value. We should always present the same at its unexpired cost, which is after charging the expired cost as depreciation. Next, funds for replacement. So obviously when the useful life of the asset is done, we have to remove the asset, we have to dismantle the asset and bring in the new asset. If we want to bring in the new asset, we need money. So for that, we use depreciation as a method. So generation of adequate funds in the hands of the business for replacement of an asset at the end of the useful life. Depreciation is a good indication of the amount an enterprise should set aside to replace the fixed asset after its economic life is over. However, replacement cost of a fixed asset may additionally be impacted by inflation or other technological changes. Okay. Ascertainment of true cost of production. So for ascertaining the cost of production, it is necessary to charge depreciation as an item of production. If that particular asset is used only for production, if there is a plant and machinery which is used only for production, then we have to take that cost. or the depreciation to calculate the cost of production. Then only we can set our selling price. No, otherwise we can't recover the depreciation cost or the cost of the asset. So when you set a price, which means the selling price, you have to take into consideration everything, all the cost, all the overheads, all the indirect expenses. Then only you should set the selling price. Further, depreciation is a non-cash expense, which means cash will not go out or come in, and unlike other normal expenditure, does not result in any cash outflow. Further, depreciation by itself does not create funds, as it merely draws attention to the fact that out of the gross revenue receipts, a certain amount should be retained for replacement of asset used for carrying on operation, which is achieved by charging depreciation that reduces the distributable profits. Okay. Factors in the measurement of depreciation. So what are the factors? First thing is cost, obviously cost, useful life. Then we have the estimated residual value. Estimation of the exact amount of depreciation is not easy as it involves lot of estimation. Generally, following factors are taken into consideration for calculation of the depreciation. Cost of the asset includes expenses for installation, commissioning, trial run, everything we added to the cost of the asset. Okay. Next, estimated useful life of the asset. Next, we have the scrap value. I don't know, these are the three things which directly affect the depreciation. Next, so the above mentioned factors can be explained in detail. How? So the cost of the asset. So cost is the depreciable asset, represents its money outlay or the amount which we give to the other party to purchase the asset, or equivalent in connection with its acquisition, installation and commissioning, as well as for additions to or improvement thereof for the purpose of increase in efficiency. We have discussed this in detail in the coming paragraph. See, next they are telling about the useful life, and all these are estimated. Okay, sometimes the useful life will be less as compared to the original one. Useful life is either the period over which the depreciable asset is expected to be used by an enterprise, or the number of production or similar units. So useful life can be in many terms: number of units, number of hours or years, it can be anything. So it can be units to be obtained from the use of the asset by the enterprise. Determination of useful life is a matter of estimation and is normally based on various factors, including the experience of similar type of asset. So if there is a similar type of asset in the company, we will see that okay, if A is also coming for 10 years, then this is also same asset, then this also will come for same years. Several other factors like estimated working hours, production capacity, repairs and renewals are also taken into consideration for the demanding situation. So useful life is based on these things. Scrap value. So what is the scrap value? The amount which you get at the end of the useful life is known as scrap value. Determination of scrap value is normally a difficult matter. Why? How can we estimate the value of the asset after 10 years sitting now? It is obviously tough or difficult. If such value is considered as insignificant, it is normally regarded as zero, which means after 10 years, if you sell the asset, the amount which you get is insignificant, which means in thousands, hundreds, then obviously we will keep it as nil only. Why to take headache? We will keep it as nil. On the other hand, if the residual value is likely to be significant, it is estimated at the time of acquisition. If it is significant, which means if it is in lakhs or a bigger amount, then we keep it or we estimate it, or at the time of subsequent revaluation of asset. Depreciable amount of an asset is its historical cost or other amount substituted for the historical cost in financial statement, which example revalued amount less the estimated residual value. So what is the depreciable amount? I told no, this one, total cost or acquisition cost minus the residual value. For example, a machinery is purchased for 1,10,000. The residual value is estimated at 10,000. So it is so what is the depreciable amount? 1,10,000 minus 10,000. This is the depreciable amount, and working life is 5 years. So how will you distribute the cost of the asset? So 1,10,000 minus 10,000, you get the depreciable amount, which is 1 lakh. You just distribute it for 5 years, normally 20,000 if it is equal. Okay, so that's what they have done here. Next, the cost of PPE. So what do we include in cost? First, its purchase price, which means the amount which we pay at the purchase, including non-refundable import duties, which means if we import from other countries we have to pay custom duty and that is not refundable for us. If it is a GST, it is refundable, we can claim credit, but if it is fixed asset, if it is custom duty, it is not possible. And purchase tax after deducting trade discount and rebate. So if there is any trade discount, reduce it, no issues. Any cost directly attributable to bring the asset to the location, example transportation cost, coolie, anything, and condition necessary for it to be capable of operating in a manner intended by the enterprise. The initial estimate of the cost of dismantling, so we have to dismantle at the end of the useful life, so we have to estimate the initial dismantling cost, or removing the item, or restoring the site on which the asset is located. So that cost also you should add. Next, example of directly attributable cost. Which are those? Cost of employee benefits arising from acquisition or construction of an item of PPE. So which means salaries, wages, whatever amount you pay, we have to add it. If it is used for acquisition or construction, then you add it. Then cost of site preparation, initial delivery or handling cost, installation, assembly cost, cost of testing whether the asset is functioning properly, because engineer will visit, he'll give a certification that if it is working or not. Then after deducting the initial proceeds, so when you're testing the item, you get output, and if you sell that, if you get the amount, you reduce that sales value. That's what they're telling here. So after deducting the net proceeds from selling the items produced while testing, professional fees, which is the engineers hired for helping the installation. Thus all the expenses which are necessary for the asset to bring in the condition and location of the desired use will become the part of the cost of asset. However, following expenses should not become the part of the cost. Which one? Cost of opening new facility or business, such as inauguration cost. So if you do an inauguration of a new building, don't add it, it is an expense. Cost of introducing new product or service, for example cost of advertisement, promotional activities, whatever you do, don't use it. Cost of conducting business in a new location or with a new class of customer, and admin or other general overhead. Once an asset has been brought to its intended condition or location of use, no cost should be recognized as part of the cost of the asset. Which means once the asset is ready, until the asset is ready, add everything to the cost of the asset, and after that don't add anything unless there is a major repair or addition which increases the useful life of the asset. So now for car you do normal maintenance, you send it to the you call a customer executive, he'll take you the car and he'll do the repairs and maintenance, you get a bill of 10,000, 20,000 depending on the brand. That you should not add to the value of asset. But now you have done such repair which is costing maybe 1 lakh and which is increasing the engine capacity or which is increasing the mileage of the business, then you have to add it. So it should be a major one, and it should increase the useful life of the asset or improve the production capacity or efficiency of the business asset. Okay. Accordingly, cost incurred while an item is capable of operating in an intended manner but it is not yet put to use or used less than full capacity should not be capitalized as part of the cost of the asset. Similarly, cost of relocation should not be capitalized, which means you are transferring from one place to another, relocation charges, that should not be capitalized. Next, any addition made to a particular item of PPE after it is initially put to use are depreciated over a remaining useful life of the asset. Any addition or extension which has a separate identity and is capable of being used after existing asset is disposed of is accounted for separately. Therefore, it is important to maintain an asset register capturing asset wise details of cost, rate of depreciation, date of capitalization, etc. All these details needs to be captured for any addition of an existing asset as well. In the absence of adequate information, it is very difficult to compute depreciation expense year on year. Also, at the time of disposal or discard of a particular asset, it will not be possible to compute gain or loss on disposal. Okay, so this is okay. Now we'll come to the important part of the chapter. So until this, we'll get maximum 5 marks. Now comes the actual syllabus of this particular chapter, which is the methods of depreciation. Okay, generally methods for providing depreciation are based on a formula developed on a duty of behavior of asset over a period of years for readily computing the amount of depreciation suffered by different form of asset. Each of the methods, however, should be applied only after carefully considering the nature of asset and the condition under which it is being used. So basically we have two types. One is straight line, where the amount of depreciation will be equal for all number of years, and the second one is diminishing balance or written down value, where the amount of depreciation will keep on decreasing because we charge depreciation on the written down value. But in case of straight line method, the amount of depreciation will be same over the life of years. So results in constant charge over the life of asset, which means the amount of depreciation will be same. If the residual value of asset does not change, results in decreasing charge over the useful life. The amount of depreciation will come down over the number of years. The income tax rules, however, prescribe the diminishing balance method except in case of asset for an undertaking engaged in generation of power or generation and distribution of power. So diminishing balance is entertained by income tax rules, but not for the companies or companies undertaking which is in the business of generation and distribution of power, which means they have to use SLM only. Other companies can use the diminishing balance method or written down value method. So the first one, which is the straight line method. So the first one, according to this method, equal amount is written off every year during the working life of an asset so as to reduce the cost of the asset to nil or its residual value, which means, see, I told now in straight line method the amount of depreciation will be same. Now how do we calculate the amount of depreciation in SLM or the straight line method? So cost of the asset minus residual value, if there is a residual value, by useful life. Okay, so this is the depreciation. So you have depreciated all the amounts. Okay, at the end of the year, what will be left? Obviously residual value. If the residual value is nil, it is zero. So that's what they are telling here. See, equal amount is written off, which means depreciated every year during the working life of an asset so as to reduce the cost of the asset. So now the cost of the asset will be zero. If the residual value is zero, the cost will be zero because everything will be depreciated, and it will be residual value if there is a residual value at the end of the useful life. The advantage of this method is that it is simple to apply and gives accurate result, especially in case of leases and also in cases of plant and machinery. This method is known as fixed installment method. So fixed installment method, straight line method, both are same. I told now how do we calculate? Cost of asset minus scrap value or the residual value divided by the useful life, you will get the depreciation. So what is the rate of depreciation? The depreciation which you calculated above divided by cost of asset into 100, you will get the rate of depreciation. Okay. The underlying assumption of this method is that the particular tangible asset generate equal utility during the lifetime, which means the benefit will be equal throughout the useful life. That's what they are telling here. If this cannot be true, but this cannot be true under all circumstances. The expenditure incurred on repairs and maintenance will be low at the initial years, obviously, because hence it is a new asset, the repairs and maintenance cost will be less, whereas the same will be high as the asset becomes old. Apart from this, the asset may also have varying capacities over the years, indicating logic of unequal depreciation provision. However, many assets have insignificant repairs and maintenance expenditure for which straight line method can be applied. While using this method, the period of use of an asset in a particular year should be considered. In the year of purchase, it may have been available for use or for part of year only. So if you have purchased at the mid of the year, so you have to charge depreciation for only 6 months, because you can't charge it for a whole year because it came at the mid of the year. So what they are telling, so 1st April 31st March. So if you purchase it here, you have to charge it for whole 1 year. What if you purchase on 17. So obviously you have to charge for 6 months. That's what they are telling you. For example, if the asset was purchased on March 1st and the enterprise prepares financial statements for the year ending 31st, then only 1 month depreciation you have to provide. Similar situation will arise in the year in which the asset is retired. So if the asset is retired also, in that year also we do the same thing. So that is straight line method or fixed installment. So next we have reducing or diminishing balance or written down value. So we have three names: reducing balance, diminishing balance, or the written down value. All the three are same. So here the fixed percentage of depreciation will be there, or we will be charging on the written down value, which means, see example, now the rate of depreciation is 10% and the value is 1000. So the first year it will be 1000 into 10%, which is 100. So 900. So 900. So this is WDV. So now I charge this 10%, not on the 1000 but on 90. So it will be 810 WDV. And next I charge on 810. So it is 729. Same like that we will be doing. Okay. Under this system, a fixed percentage of depreciation of diminishing value of the asset is written off each year so as to reduce the asset to its residual value at the end of its useful life. So obviously the amount of depreciation or the total depreciation charge would be cost of the asset minus the residual value. Okay. Repairs and small renewals are charged to revenue. Obviously it is an expense. This method is commonly used for plants, fixtures, etc. Under this method, the annual charge of depreciation decreases from year to year because we charge it on the written down value, so that the earlier years suffer to the benefit of the later years. Also, under this method, the value of the asset can never be completely extinguished, which happens in the earlier explained SLM or the straight line method, which means the cost will never become zero. This method is based on the assumption that cost of repairs will increase as the asset gets old, obviously. Therefore, depreciation in the earlier years should be high when the repair cost is expected to be low, and depreciation in the later years should be low when the repair cost is high. Obviously, when the asset becomes older and older, the repair cost will go up. Therefore, this method will result in almost equal burden in all the years for the use of the asset, as depreciation will reduce the increase in repair cost. Repair cost will increase with every passing year. So depreciation will come down, repairs will go up. So the cost will be equally distributed over the life of the asset. On the other hand, under the straight line method, the charge for depreciation is constant, while repairs tend to increase the life of the asset. Among the disadvantages of this method is the danger that too low a percentage may be adopted as depreciation, with the result that over the life of the asset, full depreciation may not be provided. Also, if the assets are grouped in such a way that individual assets are difficult to identify, the residue of an asset may lie in the asset account even after the asset has been scrapped. This is one of the disadvantages. The last mentioned difficulty could be, however, overcome if a plant register is maintained. So if the plant register is maintained, this difficulty can be overcome. The rate of depreciation under this method may be determined using the following formula. See, this is the formula. How did they calculate? Residual value divided by the cost of asset into 100. Take the root to the power of n. So if it is 2, it will be square root. If it is 3, if it is cube root, and it should be subtracted from 1. So we will see problems based on this, no worries. So now, similar to the straight line method, in this method also period of use in a particular year, which is that's what they are meant to tell here, is that if you purchase the asset in middle of the year, or when you sell it at the middle of the year, you have to charge depreciation for only those months in which the asset was there and not for the whole year. That's what they are telling here. Now comes the journal entry. So now journal entry. Okay, so we'll go with so we have basically two methods. One is that we'll keep the asset value as it is, and accumulated we transfer it to provision. So we'll keep a separate account for provision for depreciation and the liability side, and the other thing that we directly reduce from the cost of the asset. Okay, now in case of separate provision is created, so depreciation is an expense, debit all expenses. It's a nominal account. Depreciation to accumulated depreciation. So this is a liability which we create, and depreciation will be transferred to profit and loss account. So profit and loss account. To depreciation. So depreciation will be cleared. And the other method, in case asset depreciation is charged to asset. Okay, at that time it will be depreciation will be directly reduced from the cost of the asset. So depreciation nominal expense. So asset is a debit balance. So if you want to reduce the asset, you have to credit it. So to asset account, and this will be transferred to profit and loss account. Same to profit and loss account to depreciation. So this is the initial entry, and this is transfer entry, which means depreciation is transferred to profit and loss account. Okay, please note down. Okay. Next. Okay, these are the alternatives. So now we'll start solving a problem. The first problem for the day. Jane Bros acquired a machinery on 1st July, see, in between the year, at a cost of 14 lakh and spent 1 lakh on installation. Obviously total will be 15 lakh. The firm writes off depreciation at 10% at the original cost every year, which means this is a straight line method. They are charging 10% per annum of the original cost. Please be careful. The books are closed on 31st December. See, 31st December they are closing the books. So July, August, September, October, November, December. So first year it will be 6 months depreciation, and after that whole year depreciation. So we have to show the machinery account and depreciation account for 21 and 22. Simple. So first understand the journal entry. First we are purchasing the machinery. So what is the cost? So machinery account which comes in, so 15 lakh to bank account. So obviously if you are paid by bank, it is bank account. So that will be the first journal entry. Then we have to reduce the depreciation for first 6 months. What is that? Depreciation account to machinery, which will be 15 lakh into 10% into 6 months, which is 75,000 for first year. Then we'll get the balance. Then we have to do it for second year. Okay, shall we start? So we have to prepare machinery account and depreciation account. Okay. So ledger debit, credit, machinery account. So this will be date, particulars, amount, date, particulars, amount. So what is the first date? 1st July I purchased the machinery. So 1/7/21. So machinery account to bank account 15 lakh. I purchased the machinery. So 14 plus 1 because installation will be part of the asset. Okay. You can put it separately also, one entry also, no issues. So then 31st December 2021, I'll charge the depreciation. What is the entry for depreciation? By depreciation to machinery account if you are going with the second alternative. So it will be 15 lakh into 10% into 6 months by 12. So it is 6 by 12. Okay. How much is it? So 15 lakh into 10%, 1 lakh 50 into 6 by 2, which is 75,000. Any other transaction? No, I'll keep the balance now. So it is 14 lakh 25,000 by balance. Carry it down. Please be careful. Carry it down. So I'll close it for the year. 15 lakh, 15 lakh. Okay. Next 1/1/22 next year. So 2 balance brought down 14 lakh 25,000. Now 31st December 22. Only full year depreciation I'll charge. Now here it will be 10% on the original amount, which is 15 lakh into 10%. That's what question is telling, into 10%, which is 1 lakh 50. So balance would be, so 14 lakh 25 minus 1 lakh 50, 12 lakh 75. Okay, that I'll be carrying it for next year. Okay, this is the machinery account. Now I prepare the depreciation account. So depreciation, one is charge of depreciation and one is transfer of depreciation. That's all. I'm sorry. So date, particulars, amount. Date, particulars, amount. Okay. So when was the first depreciation charge? 31st December. So it will be by machinery account because the account is debited. Okay. So how much is it? 75. So this I will transfer it to P&L account. That's it. So what will be the second entry? See, it will be transferred to P&L account. That's all. P&L account to depreciation. So it will be by P&L account. $75. Okay. Next, second year, by machinery account, 1 lakh 50. Close it. So it will be by P&L account or profit and loss account, 1 lakh 50. That's it. Done. So we have completed the depreciation account also. We have completed the machinery account also. Please copy. So next, so the illustration 2. So Jane Bros acquired a machinery on 1st July 21. So same as previous question, at the cost of 14 lakh and spent 1 lakh on its installation. So the cost will be 15 lakh. It rates of depreciation at 10% every year. Say here they have not told that it is 10% on the original cost. They are telling that it is 10% every year, which means we should assume that, and it is actually returned on value or diminishing value method or reducing value method. Okay, the books are closed on 31st December. Okay, agreed. Show the machinery account on diminishing balance. See, they have only told now diminishing balance method for 21 22 machinery account. So same thing we have to do again, but the method of depreciation is diminishing value. Okay, illustration 2. So here they have asked us only to do machinery account. Okay, so because depreciation anyhow, on the debit side it will be machinery, on the credit side it will be profit and loss account. Simple. Date. Okay, the first transaction 1721. So to bank account 15 lakh. Agreed. So first year depreciation will be same. Okay, no, there will be no change on first year depreciation. So by depreciation it will be 15 lakh into 10% into 6 by 12, which is 75,000. Okay, on 31st December 22, by balance carried down 14 lakh 25,000. So it is 15 lakh 15 lakh. Okay, now the actual depreciation will come into picture, which is the return on value. So 1122 to balance brought down 14 lakh 25,000. So 31st December 21 by depreciation. Now what is the return on value? So what is the return on value here? 14 lakh 25,000. 14 lakh 25,000 into 10%, which is 1 lakh 42,500. So now read the return balance. So 31st December 21 by balance brought down, carried down. So first it will be carried down, then brought down. So how much is it? So it is 12 lakh 82,500. Okay, so 1123 it will be to balance brought down 1282,500. Okay, that's it. Please copy. So next we'll go to the next method, which is sum of year of digits method. Very, very simple. So here we just add the sum of the year of digits. So if it is 10 year, you add from the digit 1 to 10. So 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10. So you add everything. Then the numerator will be the latest year. So if it is for first year, it will be 10. If it is second year, it will be 9. If it is third year, it will be 8, and so on. So we'll see this. It is a variation of reducing balance method. So the concept is, the underlying concept is reducing balance method only. In this case, the annual depreciation is calculated by multiplying the original cost of the asset less its estimated scrap value, because that is the depreciable amount, by the fraction represented by number of years including the present year of the remaining life of the asset. So if it is at the year 1, what is the remaining life? 10. At the second year, 9. At the third year, 8. At the fourth year, 7. It will be so on. Total of the all digits of the life of the asset. So if it is 10 year, I told you it is 55. You have to add it from 10 to 1. Okay, 55. So we have another formula for that, which is nothing but n into n plus 1 divided by 2. How do we calculate that? N into n plus 1 divided by 2. If it is 11, so n plus 11 plus 1 divided by 2. 11 into 12 by 2, which is 11 into 6 is 66. If it is 10, it is 55. That's what they have done here. Okay. The depreciation to be written off in the first year would be 10 by 55. I don't know latest year. Remaining life is 10 years including the present year. So if it is including the present year, what is the life of the asset? 10 years. Of the cost of the asset less the estimated scrap value, and the amount of depreciation for the second year would be 9 by 55, because including the present year we have 9 years remaining of the cost of the asset less estimated scrap value, and so on. This method is not yet in vague, and its advantages are those as reducing balance method only. Okay, so we have a problem based on it. Shall we start? Yes sir. Messrs Akash and Co purchased a machinery for 10 lakh. Okay, estimated useful life and scrap value are 10 years and 1,20,000. So we have all the three. The machine was put to use on 1/1/17. Show machinery account and depreciation account in the books for 2022. 22, which means 17, 18, 19, 20, 21. 5 years closed. Then we have to prepare on machinery account based on sum of digits method. So first we have to find out the return on value as on 1/1/2022. For that, what we have to do? We have to reduce the depreciation amount. So shall we calculate depreciation amount for 17 till 21? So we can do manually also, we can do, which means first we'll reduce for 17, first we'll reduce for 18, 19, 20, 21. So you can do in total also. So shall we start illustration 3? Okay, so first we'll prepare machinery and depreciation, then we'll have a working note. So this is enough for depreciation. Okay, working notes. So in working notes I'll calculate everything. So total sum of digits for 2017 to 21, because we have to calculate the depreciation, no? So for 2017 it will be 10, for 18 it will be 9, 19, 8, 27, 21, 6. So for 5 years, these are the sum of the digits. So total obviously it will be n into n plus 1 by 2. Okay, so please add this. It will be 10 plus 9 plus 8 plus 7 plus 6, 40. And this will be obviously n is 10, no? 10 into 10 plus 1 divided by 2. 1, 5, it will be 55. So the depreciation will be how much? So it will be 10 lakh minus 1,20,000 into 40 divided by 55. Okay, this is the amount of depreciation from 17 to 21. So it will be 8,80,000 into 40 divided by 55, which is 6,40,000. So therefore written down value as on 1/1/22 is 10 lakh minus 6 lakh 40. So here don't reduce that 6 lakh 40 from 8 lakh 80. 8 lakh 80 is the depreciable amount, not the cost of the asset. Cost of the asset is 10 lakh only. So here it will be 3 lakh 60,000. Okay. Now depreciation for 22. For 22. So what is the digit we use here? So till here it was 6, now it will be 5. 5 by 55 into 10 lakh minus 1 lakh 20. Okay, it will be 111. So it will be 80,000. Okay, now we will prepare the machinery account. Okay, and depreciation account. I'm sorry, machinery account. So the first year depreciation will be 80,000. So this, okay. Okay, so first, what is the date? First 1/1/22. To balance brought down is 3 lakh 60. How did I calculate it? So from 10 lakh I reduce all the depreciation from 2017 to 2021. How did I do that? Using this formula. Okay, I reduced 5 years depreciation. I got the depreciation as 6 lakh 40. So my return on value will be 3 lakh 60. And the current year depreciation is 80,000. As per sum of digits method. So it will be 31, 12, 22. So 3 lakh 60, 2 lakh 80. Okay. So if you want, you can keep it for next year also. To balance brought down 2 lakh 80. Okay. Now depreciation account. Depreciation account is simple. So debit side it will be machinery, or here we have machinery, and credit side it will be plant and profit and loss account. That's it. Every time depreciation account should be closed. There should not be any balance. I'm sorry, two machinery account. It is 80,000. And this will be transferred to profit and loss account. It will be 80,000. Okay. Done. Ledger is closed. Please copy this. And in exam, please maintain the presentation. Okay, presentation is very much important in examination. Okay, please copy. Next method. So sum of digits. Okay, now we have machine hour methods, simple methods. All these are simple methods, I'll tell you. Where it is practicable to keep the record of actual running hours of the machinery, depreciation may be calculated on the basis of hours that a concerned machine worked. The machine hour rate of depreciation is calculated after estimating the total number of estimated hours that a machinery would work during its whole lifetime. So simple. Take depreciable amount. How do you calculate it? Cost minus residual value. Depreciable amount into actual hours work divided by the total hours in its useful life. Simple. Okay. However, it may be varied from time to time on a consideration of changes in the economic and technological conditions which might take place. To ensure that the amount provided for depreciation corresponds with the considered appropriate in the changed circumstances, it would be observed that method is a variation of the SLM, which is under which depreciation is calculated per year. Under this method, it is calculated each hour that the machine works. Schedule 2 of the Companies Act 2013, which prescribes estimated useful life of the different assets for companies, also recognizes this method to some extent. So in normally Companies Act we follow two methods, which is SLM and WTV, but it also recognizes this method also. It prescribes that a depreciation should be charged using estimated useful life suggested in it. However, in certain category of plant and machinery, it prescribes charging higher amount of depreciation if these assets are used for 2 or 3 shifts. So obviously, if it is working for 2 or 3 shifts, obviously it is using more time. Obviously, we have to debit extra. In this way, in a way, Schedule 2 combines straight line method and machine hour method. Okay. So based on that, we have the problem. See, a machinery was purchased for 30 lakh having estimated total working hours of 24,000. See, 24,000 hours. The scrap value is estimated to be 2 lakh, which is the residual value, and anticipated pattern of distribution of effective hours is as follows.